Okay, so this is sale and leaseback question. Meridian Properties Limited owns a commercial office building that it has occupied for several years as its head office. On 1st January 2024, Meridian entered into a sale and leaseback arrangement with Atlas Real Estate Fund, carrying amount as at 1st January 2024, $6 million. Fair value of what? Of building at 1st January 2024, 10 million. Sale price agreed, 10 million. Lease back term, 5 years. Annual lease payment payable in arrears, 600,000. Incremental borrowing rate, 5 per annum. Useful life of building, original, 40 years. Transfer of building to Atlas has been assessed and qualifies as a sale under IFRS 15. Meridian years ended is 31st December. Now, calculate what? Lease liability and right of use of assets. Calculate gain on sale to recognize in profit and loss account. Prepare journal entry in the what? In the book of Meridian. Prepare lease liability amortization schedule all 5 years. Prepare extract from the state of financial position as at 31st December 2024. So this is what the question under sale and lease back. This question is under sale and lease back. Now, in the question, let us summarize the question. What did they say? In the question, they said carrying amount as at 1st January 2024, when the agreement was what was entered, carrying amount of the asset of 6 million. Fair value of the building is what? 10 million. Sale price agreed is 10 million. Lease back term is what? Is 5 years. Annual lease payment is 600,000. Okay. Borrowing cost is how much? 10%. 5%, sorry. 5%. And the useful life of the asset is how much? 40 years. Okay, so this is that is it about that. Okay. Now, when preparing accounts under sale and leaseback, or you are accounting for sale and leaseback, there are steps that you should follow. First step one, identify if there is what? There is sale, which forms and what? IFRS what? 15. So meaning there is what? One, transfer control of the what? Of the assets to the what? To the buyer. And two, okay, so if there's a transfer control of the asset to what? To the buyer. All right. So good. So to identify that. Now in the question, let's check. In the question, look at the last where you say that the transfer of the building to the asset has been assessed and qualifies as a sale and IFRS 15. So it means yes. It means the transaction. So you say yes, the transaction qualifies as what? As IFRS what? 15. That's what. Now two. Now calculate your what? Your lease liability. Right. So how do we find our lease liability? Our lease liability is what? Our lease payment, which is what? 600,000 given in the question. And then we will have our, let me hang 3 zeros, which is 600. So we have what? Annuity factor, which is what? 1 minus into bracket 1 plus r to the power of r negative n. So here we know our what? Our interest rate was 5%, which is 0.05 to the power of to the power of how many years? In this question, how many years is the what? Is the lease term? The lease term is how many years? So let me go there. So the lease term is how many years? 5 years. All right. So the lease term is 5. So negative 5. So what do we have here? So we will have what? Negative 5 divided by 0.05. Okay. So this gives me what? 4.33. Okay. So 600 times 4.33. Okay. So this gives me 2, 5, 598. So this is my what? My present value under this contract. Now, when you are done with what? With 3, then you find your what? Your right of use of asset. Now, with sale and lease back, we cannot get our right, we cannot get our full right of use. So this is the formula. So the formula for determining the right of use of asset under sale and lease back is what? You have what? Your right of use of what? Of assets is equal to what here? The first one is carrying amount. You pick a carrying amount of the assets that you sold, multiply by what? Present value that we just calculated here, which is our what? The present value here. Or you can say our lease liability. Present value lease liability, which is lease liability that we just calculated. Then you divide all of it by the what? By the fair value. How much is the fair value? So our fair value is how much? 10,000. So you divide that fair value of the asset. So when you do this, it will give you the what? The right of use of assets. That is the formula for what? For determining right of use of asset under sale and lease back. You see, the idea here is that this asset was sold. So after selling it, you lease this asset back to your what? To your food to be used, so that you what? You pay regular what? Fee for the usage of what? Of the asset. So for that reason, in order to what? In order for you to get the what? The right of use of asset, this is the formula that you have to use. You pick the carrying amount that you've derecognized from your book after selling, and then you divide that, you multiply and divide that by what? By the fair value of what? Of the assets. How much could the asset be sold in the what? In the market. That will give you what? Your right of use of assets. And that is, so this is the formula for determining that. So in this instance, what do we have? We have our carrying amount in the question to be how much? The carrying amount is what? 6 million. So you pick what? 6,000 multiplied by lease liability as we calculated is what? 2,598, or by fair value, which is what? 10 million. So what do we have here? Answer will be how much? So that gives me right of use of asset is what? 1,558.8. Okay. So that is your what? This is our right of use of asset. So the fourth step is what? Is to calculate what we call gain recognized. How do we calculate the gain recognized? Watch here. This is your what? Your full gain on the asset. What does this mean? You have what? The fair value, the selling. You say you sold the asset. The asset belongs to you and you sold it. So how do you get the what? How do you get the gain? So what is the gain of what? Gain on what? On selling the asset. What is the gain on selling the asset? So in order to get the full gain, what is the carrying amount of the asset? Before you sold the carrying amount of the asset is what? Is 6 million. And how much did you sell the assets? 10 million. So here you have your what? Your sale price minus what? Minus the carrying amount of what? Of the assets. So that gives you a gain. So here the selling price is what? 10 million minus the carrying amount, which is what? 6 million. So when you less it, what do we have here? So here you have what? 4,000. Now this is the full gain on what? On the asset. And the standard says that we cannot recognize all the 4,000 gain. You remember, you are the what? You sold this asset to a buyer. You lease this asset back. And remember, this asset that you sold, you lease it back. So when you lease it back, there's a gain after you've sold this asset. And the standards say that this gain cannot be recognized fully by you. Part of it what will go to the what? To the what? To the lessor, the owner of what? Of the assets. Then part of you what will be retained by you. The reason why when you look at right of use of asset, we couldn't what? Recognize fully all the what? The asset value in our books, because we sold it and we are leasing it back. So not all of them what? Will be apportioned to you to use. All right, so the same applies here. So when you get this, so how do we get the what? Gain that will be recognized by you? The one who have, so you say what? Gain recognized is equal to what? The full gain what we just calculated, multiply by what? Multiply by the fair value of the asset. So the fair value minus what? Minus lease liability. All by what? By the fair value. So here, how do we get it? We know our what? We know our full gain to what? To be 4,000. Multiplied by fair value is how much? 10,000. And our lease liability, we just calculated it. Is what? 2598. All by what? By the fair value of what? 10,000. Okay, whatever you get is what? Is how much can be recognized by you. So let's do it. So you have 10,000 minus 2598 divided by 10,000 times 4,000. So you will get what? Out of 4,000, you will get what? 2,006. This is what you will get. Will be recognized in your books. So that's what that is it about that. Between this one and this one, you will have what you call the remaining gain. So what here? The remaining gain will be how much? You have what? 4,000 minus 2,961. The balance will what? Will be 1,039. Right? 1,039. So this 1,039 now, what will be what? Deferred. Will be deferred within what? Within the what? Right of use of asset. Okay, so let's see how what we prepare the journal entry. So when you are done, watch here. If you want to find out your next step, whether you've done the right thing, so you find it. So you have what? Your next step, what you prepare your journal entry with this. So how do you prepare your journal entry? You have your debit here, you have your credit here. You show the asset. How much did you sell the asset? You show the asset as at what? 10,000, 10 million. So that is cash coming in, bank. So which is what? 10,000, 10 million. It will come to you. The carrying amount of the building that you sold, or the carrying amount of the building is how much? The carrying amount of the building is what? Is 6 million. You de-recognize because you sold it. You sold it, de-recognize. So when you de-recognize, where does it go? You go to a credit side. So which is what? 6,000. Now the next item to be recognize what? Now, when you de-recognize the asset that you own because you sold it, now your right of use of assets, you've leased it back. So it becomes right of use of assets. Then you debit it because it is what? It is non-current asset item. So what is our right of use of assets? Let's go. Our right of use of assets is of 1558. You debit it. Point what? 0.8. You debit it because it is what? You remember, right of use of asset. I've already said that they are what? Is what? It's a non-current asset item. 8.8. Now, once you have right of use of asset, you have what? Lease liability. Lease liability is what? It's a liability that you are going to pay over the period. What is our lease liability? It's what? 2598. That one is what? Credit balance. Because a liability that you have to pay over the period. The difference between the debit side and the credit side will give us what? Gain on sale or loss on sale. So let us look at it. So here, what do we have here? So debit side, 10,000 plus 15, 8.8. That gives you what? 11,558.8. Okay. Then credit side is what? 6,000 plus 2,598. 2,598. That gives you what? 8,598. Let's balance it. So you see, so the credit side will give us what? 29,600.8598. So the difference between the credit and debit side is what? Is 29,600.8. Now go to your what? Your gain on your sale. What do you have here? 29,601. So let me round this up also. So that gives me what? Point? That gives me what? 29,600. It has balance. So the gain recognized is the same as for the balance that we have here. So even if you like, you can decide to even not to calculate the gain on recognized to be recognized. You can leave that one to come and prepare your journal entry, and you will still get the what? You will still get the answer to it here. All right. Now, if the question asks us to prepare amortization table, what do you do? So amortization, you have what? It says for the 5 years. So you have years, have your balance brought down, have your interest of 5%, you have your lease payment, you have your balance carried down. Okay, so you have your 2024, 2025, 2026, 2027, and 2028. 1, 2, 3, 4, 5. All right. Now we can we can comfortably work on our amortization table. We know our lease liability to be how much? 2598. Have 2598. That's what 129.9. Our lease payments, year lease payment is for 600,000. So our balance will be how much? All right. All right. So we have 21,9 to 7.9. So that becomes your opening here, 2127.9. So what becomes our closing balance here was 2127 4.3. So that becomes our opening here. And the interest, of course, 5%. That gives us 81.7 plus 1634.3 minus 600. So that gives you 1116.0, 25.8 plus 1116. That'll give you 541.8. 541.8. So this gives me 55. All right. So that's 0.05, 28.6 and your 600. So here you use 0 point. All right. So at the final year, you should be able to get, you should be getting. So that is it about the amortization table. So the next line of action is to do your profit and loss extracts. Okay. Okay, so if we are to do our statement of financial for maybe year 1, 2024, if we are to do only year 1, the rest will follow same. So year 1, our interest payment for the year 1 will be how much? Will be 129, or let's make it 2 years. And the other year will be how much? 106.4. I will look at the gain on what? On sales. What did we say? So we had what? 2961. Depreciation. Depreciation. What's the right of use of asset or the asset? What right of use of asset is how much? 1558.8. 1558.8 divided by 5 years. So the 5 years is what? Is the term of what? Of the lease agreement of what? Of the asset. So every year, depreciation is what? 311.76. 311.76. Right. So your statement of what? Financial position. But also you have 2024 and 2025. So you have your right of use of assets. So year 1, that's what? You have what? 1558.8 minus depreciation of what? 311.7.76. That gives you how much? 1247.04. Less depreciation for year 2. 311.7 issue 935.28. Now you can think about all your liabilities. Afterwards, current lease obligation, current lease obligation. So we are doing only 2 years. So we go to the ball. Year one, 2025 and 2026. 2025 is 16,344.16,344.3. Okay. 11160. So the current asset rewards. So you find the total here. So you bring the first 21, 27, 21, 27.9. 16,344.3. Okay. So we have 21, 27, 49, 3.6. Is 18.3. So that is it about sale and lease back and its accounts. Thank you very much.